Mortgage rules are set to be eased, as you've been hearing on the headlines. The central bank may allow people to borrow up to 4 times their income. They were able to access loans of up to 3.5 times income, and that will go up to 4 times. That's what the rumour machine is telling us. We'll have confirmation in a little while. But to see how this might impact first-time buyers and the economy as a whole, I'm joined by the Managing Director of doddl.ie, Martina Hennessy, and by Financial Advisor and Director on the Irish Banking Culture Board, Paraic. Kissane. Good morning and welcome to you both. Martina, first of all, what impact will this have on the market, a market that is short of supply?
Well, so Pat, mortgages are one element of the overall housing market, and the rules changing and the availability of additional finance for people to borrow to buy homes will mean that I suppose there could be more demand created within the market at a time when housing supply is short.
Housing supply is short. So I'm wondering, you see, my experience of looking at the construction industry and developers and so on is that they charge what the market will bear, not what the actual cost is, add in a bit of profit and so on. And sometimes developers around the time of the crash even had to get rid of stuff at a loss. So it's about the market. So if people have more money in their pockets when they go to see new developments of houses, surely that's just going to push the price up.
I think, Pat, no one wants to borrow more than they need to, but the reality is that to allow people to buy at the moment based on the cost to build, and especially for new homes, people need to borrow more. So it's not that people want to borrow more, but there is a need, especially we would see with our clients, particularly first-time buyers, to be eligible, to be able to borrow more where it's affordable. So while these increases of up to 4 times income multiple from 3.5, if they do come into effect, will mean people can borrow more, the banks are still operating and stress testing mortgage applications that are coming in the door. So it's not that there will be an automatic eligibility for everybody to borrow 4 times income. We're looking at a backdrop where interest rates are increasing, cost of living is increasing, and the banks aren't going to, I suppose, lend in a manner that isn't affordable for people. But what really the central bank are looking at is the overall framework that they're working under and whether it's still effective in the current economic environment where affordability is in place and where people can afford to borrow more. This will just allow people to be able to borrow more and many to be able to get out of the current rent trap that they're in, where they're paying more in rent than they actually would be in a mortgage. So while the rules are changing and it will increase the ability for people to borrow more, it will be under measured kind of circumstances that the lender's own credit risk and lending policy will still prevail. So while you might see or might feel that this will increase the amount people can borrow, we're in an environment where rates are increasing, and that in itself restricts the amount that people can borrow. So, obviously I suppose the concern is that it will lead to increased rate or lending or increased property prices, but really it is measured. It is going to be a measured impact.
See, I'm wondering, are there any developments that are unsold? I mean, you see the odd housing development and apartment complex coming up for sale. As you know, most of the apartment complexes in the Greater Dublin area that are being finished are built to rents, which is another scandal in itself. But anyway, those complexes that are coming on stream, housing and so on, are any of them left unsold? Is there not, a bigger customer base for them than there is a supply?
Yeah, well, my clients would say that they still find it difficult to secure new builds. There's still waiting lists. New builds years ago when they were being built, they were built off plans. There wasn't a sod turned on the land when they were being, sold off plans. Now they're being released as they're being built, and there certainly is a huge demand there. First-time buyers, there's a number of schemes which are first-time buyers available, such as the Help to Buy scheme, the Shared Equity scheme, which are for new build properties. So that increases demand for new build, because there's supports there in place for first-time buyers. In my experience with my clients, it is a real challenge for them to secure a new build. So I don't believe that there is new builds that are sitting there waiting to be, acquired. I really think that the demand is the issue, or supply is the issue as opposed to demand.
Yeah, and what about old builds, second-hand housing? Is there a surfeit of that on the market? Because, you see, all I'm saying is that if you know that the young couple coming through the door now have more money in their pockets thanks to the relaxation of the central bank rules, your asking price for that second-hand property may just creep up.
and that is a concern, and it's something that's been voiced by a lot of our clients. We did a poll on our social media, and to say, will this help? And there was certainly 30% of people thought it would definitely help, but there was a concern. 70% of people felt they were concerned that rates or that property prices would increase. It's yet to be determined, but again, it's all to do with affordability when we're talking about mortgages. Mortgages are one part of home buying, and for mortgages, it all comes down to affordability. So these rules will allow people where it is affordable for them to purchase properties to purchase them at to have more disposable or more mortgage power to buy, and in effect, you would have to feel that may have some impact on property prices. But again, the bigger concern is obviously there has to be the supply element is the core challenge, I think, in home buying.
All right. Look, Martina, thank you very much for contributing. That's Martina Hennessy, the CEO of doddl.ie. Paraic Kissane listening to that. Paraic, good morning.
Good morning, Pat. How are you? Good to speak to you again.
Now, what do you make of what looks like a decision by the central bank to allow people to borrow more?
Well, there's a couple of things I would say. First of all, just to I suppose, look back, the rules were put in place initially in 2015, and it was essentially to prevent a further bubble in the market that had occurred in the 2008-2009 period. So why it was put in place was to stop and prevent anyone overborrowing, because I suppose the easiest way to put it, the trust wasn't there that the banks wouldn't do it themselves. And I heard Martina saying that the banks are prudent lenders. There was a fear that they mightn't remain prudent lenders back in 2015, and that's why it came in. Now, it certainly didn't keep pace with where both the industry and the marketplace went. I mean, generally speaking, of old, and I've just actually gone back and authorised myself again as a mortgage intermediary through the central bank for the very reasons that you're coming to in terms of supply and everything that comes here. Mortgages before were always lent on a percentage of your net income of what you could afford to repay, and that was, generally speaking, throughout Europe would have been between 30 and 40%. The problem in Ireland is a lot of those people that are looking to buy are spending 50 and 60% of net income on rent. So the mortgage, for example, if you take a mortgage of 350,000, which is the max somebody could borrow, let's say yesterday, over 30 years as a first-time buyer, that's costing 1372. 400,000 over 30 years is costing 1611. But those people in that type of property purchase are renting probably at 2,500 or 3,000 per month, and that's the catch-22.
No, I get the point, and so many people want to get out of renting, and particularly in the greater Dublin area where rents are horrendously high. But the point is, there's nothing to buy. So the limited amount of property that is there, the developers are just going to say, well, we have a commodity now that we were going to sell for 425. We should easily get 460 now.
Well, it does increase the amount. So if you can borrow more, it also increases the amount of the deposit you have. And part of the complaint has been that the only people, and I don't mean this generically across the entire industry, but the only people able to afford properties up to now were people who had a substantial deposit or the gift of a deposit. And they were the people who were qualifying within the rules as existed. I think the central bank will have to look at moving it more towards the net of income cost of the 30 or 35% of people's net income should be affordable towards mortgage, because realistically people are going to have to start stress testing the cost of a mortgage at 5% now, where up to now 2 and 3% would have been more reasonable. Today, with the future look of where interest rates are going to go, it's more likely that you need to be considering 5% as your repayment. But if supply improves tomorrow morning, this is absolutely to be welcomed, Pat. If supply doesn't improve, it makes no difference.
It makes no difference, but for those developments coming on stream, it does make a difference that the providers of those developments will say, well, I can push up the price. We have a queue of people. We now know that they are capable of getting more money from their lender because they have good incomes and so on. They're going to get more money, and let's push it.
I believe, Pat, though, that might be a desire, but I think the reality is with increasing interest rates, people, what they had to pay for their mortgage a year ago compared to today has increased the cost per month. So the property price is going to be affected by that. Any of the houses coming online that are trying to tell somebody that they will be able to charge more because somebody can borrow more. Somebody who can borrow more is paying more than they did this time last year. The price of property in all increasing interest rate environments either stabilises or decreases. it has never continued to go up. The only reason in Ireland it's unique is simply because there isn't a supply of those houses.
So the central bank is kind of loosening the rules a little bit for people who are looking to buy a property. However, you're suggesting that the banks are going to be the real arbiters of how much money is given out, because it'll be the nature of their stress testing that will determine how much people actually get.
Which is why I think if we go back to the net income and what percentage of your net income are you paying towards a mortgage is a far better measurement than looking at a time salary, particularly when that time salary is off a gross salary. If you start looking at the net income and Pat Kenny decides he can afford to pay 35% or 30% of his income per month to a mortgage, particularly now that we have long-term interest rates, fixed rates, so you can set your figure today and know that it's never going to change for a longer period than it used to be, that is a far better approach. Now, if that equates back to 4 times salary, well, then all the equation all works out. Generally speaking, it doesn't, though. And what a lot of the first-time buyers and a lot of them that I've started to talk to and going back in doing mortgages now to advise people, because the advice required in a rising interest rate environment is entirely different to how much can you borrow.
Now, as an intermediary, Paraic, and you've now registered yourself again as a mortgage intermediary, will you have access therefore to all the stress test methodologies of the different lenders? Because I know that, for example, they might ask you, do you have any loans out? Do you have a car loan? Do you have this loan? Do you have maybe a student loan that has yet to be repaid? They look at all of those things, or they could. Will you have access to their methodologies?
Well, I think what I would do, Pat, was when I meet somebody is take on the journey. In other words, there is little point in anyone borrowing money that is going to run into difficulty in the repayment of that money. That serves no purpose. So for me not to be able to assess what a car loan is costing, or a term loan, or a current account, the behaviour of an account holder or the behaviour of a potential client is what I would watch. In other words, how ready are they to purchase? A lot of the discussions that I have with people is about preparing for the purchase of a house, which in other words we mightn't be at deposit stage, or we mightn't be at application stage. It's actually assisting them in the journey towards purchase, and hopefully that will align with a dramatic improvement in supply, which is what is needed first and foremost in the country, as we know, both for renters and for housing in general, but for first-time buyers in particular, some of which are earning substantial levels of money in industries that are going to come under more and more pressure if we don't supply that housing in order to fill the vacancies that are available.
All right, Paraic, interesting stuff, and lots of people have views on this, but for the moment, Paraic Kissane, who's a financial advisor and director on the Irish Banking Culture Board, thank you. Some of the texts coming in are very interesting. Changing these rules is tantamount to allowing more people into a supermarket that has empty shelves. That's from Ed in Selbridge. Declan Kildare says higher borrowing won't improve affordability, just allows some people pay higher prices. Strange that rules are relaxed as prices hit a record. What is good for some individuals may not be in the collective interest. 2 points. One, the easing of rules caused a bubble. Everything went up in price. Fianna Fáil and Labour stopped building council houses. The vultures came in. Banks are bailed out. They don't care. Neither do the vultures. This is going to cause another bubble. Things will get worse. Interesting one. Your Dublin-centric what the market will bear premise does not factor in the parts of the country where prices will not fetch the minimum actual cost of building, which is $250,000. This stops development. Buyers then need help to borrow a higher amount so that builders can afford to build and get the price that it's cost them. Bob says people have for years been paying more on rent than they would on the mortgage they seek. Just stop this barrier. Recognise rental payments, and that won't increase house prices, and then no bigwigs will make the extra few bob.